Hey guys, how you doing? This is Alessio. Now, I'm going to play this clip in just a moment. Before I do that, I just want to give you some context. Gentleman you see here on the right-hand side is Jim Rogers. You might recognize him. And Jim Rogers, in case you don't know, is a billionaire investor. He's made a lot of money in gold and other assets. And whenever he says something, we do pay attention to what he says. And in fact, in this interview, which was recorded only about a couple of weeks ago, very recently, he makes some very interesting and shocking predictions about the markets, which you want to pay attention to. And I'm going to explain to you why there are now 3 reasons we need to be concerned about what's happening on the stock markets and how that relates also to Bitcoin as well. So let me go ahead and play the clip for you first.
You say that a huge sell-off is coming, the biggest in my lifetime. So when is it coming? First of all, that's the first question. When?
You know, crashes don't happen in one day. The market is going to go up for a while. I'm still optimistic about the U.S. stock market for a while and Asian stock markets. It'll go up, and sometimes later this year or next, the decline will start in. But it doesn't happen in a day. And Stuart, when I said it's going to be the biggest market downturn in my lifetime, I mean, that's not so strange to me. 2008, we had a problem because of too much debt. Stuart, as you well know, the debt has skyrocketed since 2008. Yep. So when I say it's going to be worse than my lifetime, how could it not be?
So you're a debt bomb guy. You're saying, look, the crash is coming, the huge sell-off is coming, and it's because of debt. So you say, I asked you when, and you kind of hedged a little, maybe late this year, early next year. And then I asked why, and you said it's the debt bomb. So that's your scenario here.
Yes, I mean, Stuart, do you remember 2008 and 2009? That was because of gigantic debt. It's getting worse. It's much worse now. The Federal Reserve alone's balance sheet is up 500% since then. By the way, Janet Yellen says we're never going to have another bear market in our lifetime. So maybe you shouldn't listen to me.
All right, guys, so let's examine and unpack what Jim Rogers just said in that interview. Firstly, he is absolutely right. The levels of debt have tremendously increased. For example, take a look at this chart of margin debt, how it's skyrocketed in the last few years. In fact, margin debt, in case you're not aware, is the amount of money people borrow to put into the stock market. And you can see whenever it's skyrocketed, whenever it's risen extremely high, it has led to previous market crashes as well. Now, take a look at this. This is an important piece of research from UBS management. Now, UBS found, according to their data, that certain cities, a lot of cities actually around the world, are reaching bubble and overvalued territory when it comes to property and real estate. Property prices around the world, certain cities have reached bubble territory, including London. And let's go and take a look at this particular chart that I'm showing to you here. This is the chart of the Dow Jones Industrial Average, one of the key stock market indices in America. And as you can see here, again, Jim Rogers is absolutely right that the trend in the stock markets still remains to the upside. We still remain in an upward trend. For one thing, the stock markets are still above their 200 moving average. That's the green line you see there. And as long as we're above the 200 moving average, the bias is still towards a bull market rather than a bear market. But here's something we do need to remind ourselves of, which is that it is true that a trend is your friend, but the actual phrase is the trend is your friend until the end, because every trend in the market eventually does come to an end. Now, what interested me in that interview was that previously, Jim Rogers had been bearish on the stock markets. And it's only quite recently that I've noticed he's taking a more bullish stance on the stock markets. So in that interview, you'll notice he said, look, I'm still looking for the stock markets to continue rising. Now, why did he say that? And I found something very interesting here, which I want to bring to your attention. This is the chart of the sentiment cycle as markets go up and down. By the way, this sentiment cycle can apply to anything, not just stock markets, but also other markets too. What this chart tells you is how people think as markets are going up and as they're going down. When prices are going up, and especially when we're in bubble territory in a very huge bull market, at this point, anyone who goes against the trend of the market, anyone who says, look, I'm against this market, I don't think it's going to go much further higher. In other words, if you're a contrarian, you will get ridiculed. The same thing happens in reverse. When markets drop or crash, right about the bottom or near the bottom, anyone who gets bullish on the market, who says, hey, look, I'm looking to buy this market at this point, they also get ridiculed and they get trashed. Again, because what they're doing is going against the majority opinion. So remember, guys, one of the things we have to remember is that as contrarians, we have to be brave. we have to be brave enough to go against the majority of people out there, because the majority of people are usually on the wrong side of the market. A good example is what happened to Bitcoin about December of last year, when you may remember Bitcoin hit about $20,000. At that time, anyone who went against the majority opinion, and the majority opinion was, hey, Bitcoin is probably going to go to $50,000 or $100,000. Anyone who went against the majority, against the herd, would have been called a fool, an idiot, and of course, they would have been ridiculed. In fact, listen to what Jim Rogers himself says about the danger of following majority opinion.
But what I've learned in life is, normally when everybody's thinking the same way, you should start at least thinking, hey, wait a minute, it cannot be right if everybody's thinking the same way. And it nearly always is that when everybody's thinking the same way, somebody's not thinking, and you should at least examine the other side.
So you'll notice that in the interview between Jim Rogers and the presenter there, that he actually was saying, hey, you know what, I'm expecting that stock market prices are going to continue going up because the trend is still to the upside. And I think the reason why Rogers said that is because he's a human being. Just like the rest of us, he does not want to be ridiculed in case the markets prove him wrong. And there's something else I want to mention here as well. One of the major market analysts that I respect, he recently said that there's now a high degree of certainty, and I'm quoting, he said there's a high degree of certainty that the stock markets are now going to make new highs. When I heard that, alarm bells were ringing in my ears, because he did not use the words high degree of probability. He used the words high degree of certainty. Now, why did he say certainty and not probability? Because I think that he's becoming very confident, perhaps overconfident, that the market's going to make new highs. And guess what, guys? Whenever anyone says there's a high degree of certainty that something's going to happen in the markets, be very afraid and be very cautious, because that's usually about the time the market's about to turn and do the exact opposite. Because if someone thinks there's a high degree of certainty that something's going to happen, then he is not the only one. And there's another reason I want to show you here, which is also important. You see, the Dow just recently, as you can see in the last few months, has been making 3 tests of this level. In fact, if I just draw a line here, you'll see what I mean, as you can see. So the Dow here has been testing this level now, not just once, but twice, 3 times. Okay? Now, why is that important? I'll explain that in just a few moments. Let me show you also what's happening on the S&P 500, the other major market index. You'll see that the S&P also has been doing the exact same thing. It's now testing this level around about 2580. In fact, you'll see it's testing this level again, not once, not twice, but 3 times. And in fact, also you will notice that the S&P has been testing this 200 moving average here, that green line you see on my chart. It's testing that level once, twice, 3 times. Now, why is that significant? Because there's an interesting theory in chart analysis that the more often price tests a key level, the more often the price comes to a certain level, the more likely it is it's going to break it. Okay, so let me just repeat that because it's so important. The more times a market comes to test a key level, in this case the 2580 level here, the more likely it is that the market is going to go and break that level potentially soon in the next few months. So I think the fact that the stock markets, both the S&P and the Dow, are now testing this support level around 2580 on the S&P and a corresponding level on the Dow. The more times they're testing this level, the more likely it is that the markets are soon going to come down and break that level. If you just bring this chart a little bit to the right, okay, to the left, I should say, I think now the probability is more that we're going to soon, potentially in the next few months, break this level. All right. And in case you're wondering, is that a big deal? Absolutely, it's a big deal, because there's also another theory in technical analysis of what's called breaking market structure. And by the way, it isn't just the S&P here that worries me. It's also what's happening on the NASDAQ. Let me bring the chart of the NASDAQ so you can see for yourself. Okay, here's the NASDAQ. Okay, now take a look at an interesting pattern that's developing here on the NASDAQ. What you see here is what's called in chart analysis as the head and shoulder reversal pattern. And the trigger for a reversal occurs when that happens, when the price breaks that neckline. So let me show you that chart of the NASDAQ. So this is the NASDAQ 100. Now, the pattern is not yet complete, but we can see something emerging here. Let me just show you this. You'll see this is potentially the head. This is the left shoulder. And likely this is the right shoulder. It is true that at the moment, the way things are shaping up on the NASDAQ 100, there is a sort of head and shoulder pattern, a bearish pattern developing here. Now, if the NASDAQ manages to break out and make new highs above 7,200, then that pattern is void. It's invalid. On the other hand, if the Nasdaq sees more weakness, and if we perhaps fall further, then this pattern begins to form completion. So going back to our chart, the S&P, bottom line is, guys, that as long as we're above this support level, as long as the stock markets continue to remain above 2580, yes, the path of least resistance is to the upside, and Jim Rogers is right. The trend is your friend. However, based on everything I'm looking at here, the fact that we're testing these key levels, the fact that so many market analysts are now jumping on the bandwagon that we're going to make new highs, that has me worried, that has me cautious, and I personally think that Jim Rogers will be proven correct this year, that we're potentially heading for lower levels on the major stock markets. All right, guys, let me know what you think. Do you agree or disagree with what I've just said here in this video? Do you agree with Jim Rogers on the points he made? And guys, if this video has helped, then please give it a thumbs up. And also please remember to subscribe to our videos for future updates. Thank you very much.